In this third module on time value of money, we're going to consider a construction where we look at cost versus benefits in what's thought of as a net present value. So we're netting out our costs against our benefits. And we'll consider the development of a decision rule that we need to use for this. And then finally, we'll both motivate an equation with the equational forms that we know. We'll do it longhand, if you will. And then we'll similarly go ahead and work this equation with our HP calculator. So first of all, let's consider the concept of cost versus benefits. We know that investments of any kind, whether it's an asset purchase, a purchase of stocks and bonds, an investment in a company, a loan, what have you, has certain costs associated with it, and it has the benefits associated. The cost might be that we invested $1,000 in a very small business. The benefits might be that it gives us cash flow of $400 a year for some period of years, and we might be able to sell it at a point in time in the future. Or if we're thinking about a stock, the cost would be that we paid $10 a share. The benefits might be that we get 10 cents in dividends each year and then someday sell it at a specific value. So we can think of the costs and the benefits, and when those equal each other, we know we have a transaction that we like. But we need to think about costs and benefits in a present value condition. So we think of the present value of our costs, which typically occur at one point in time, and we're going to think of that time as upfront, and maybe that's at the time signatures, versus our benefits, which may happen at one point in time at a specified date in the future, or might happen over a period of time, a little bit at a time. So now we're looking at a cash flow. When we think about this, you have to realize that costs are going to be all measurable costs. It might be hard for these to include opportunity costs, but all measurable costs. We invest $150,000 into a piece of rental property. We then also have the costs of maintenance and upkeep, the costs of capital renovations and such. We have to think about all of the costs. Similarly, have to think about all of the benefits. We get rental income from the renters. We might get some tax benefits and such. Now, obviously, when it comes to something as complex as a rental property, the calculations would be similarly complex. But if it's something easy, let's say that it is a $10 per share purchase of stock that we make today, and we receive 6 cents a share in dividends each quarter for the next 20 years, and then we sold that for $112. We can think about what the net present value is, or the present value of our costs versus the present value of our benefits. So let's think about the formation of a decision rule with respect to this. If the costs equal the benefits, so if the time discounted cost equals the time discounted benefit, then that's probably a transaction that we're going to be interested in. If the costs exceed the benefits, well, probably not interested in that transaction. Or if the benefits exceed the cost, now we may be very interested in the transaction. So we have to think about this in a time discounted construction, and we have to think about when the costs equal the benefits, what that means, when they're less than, and when they're greater than, and what those mean as well. So let's look at the net present value construction itself. We're going to look at net present value in our basic present value, but in this case, we're going to consider the costs and the benefits in the same side of the equation, such that we really are looking at net present value is equal to the sum of the cash flow or benefit over a period of time divided by 1 plus r to the t. So we're going to look at each of this. This is going to be a summation. So we'll take every one of the benefits. We're going to call those B for beta or benefit at time t. So there might be numerous of them over numerous periods. We're going to divide that by 1 plus r, our discount rate, to the power of t, t being an exponent for number of years or periods here. And then we can subtract the of our cost over whatever periods they might exist, divided by 1 plus r to the t again. Remember that as we've talked about time value of money, that r is simply a discount rate. Maybe it's a rate of interest we're paying. Maybe it's a required return we're getting. Maybe it's some opportunity cost of the capital we're investing. It's our discount rate. Well, we're going to think of this in costs are negative, benefits are positive, of course. And so now we can go ahead and consider how this might play out in the decision rule. So if the net present value is, that means the costs were equal to the benefit. And the expected R, our discount rate, has been received. No more, no less. And if that's the case, then the economic agent is indifferent. Yes, they're going to get exactly what they asked for, no more, no less. They may as well take the transaction. If the net present value is less than zero, so it's a negative value, that means that we receive less in the way of return than we expected. If we were looking for a 12% return and we had a negative net present value, that would mean that we didn't receive a 12% return. We received less than 12%, and so possibly we wouldn't be interested in that transaction. Whereas if the net present value is greater than zero, that's going to suggest to us that we received more than our 12%. We'll look very briefly at in the final item on this at what that actual real experienced rate was, and that's referred to as an IRR, or internal rate of return. So let's go ahead and look at a net present value equation. Let's assume that we have an asset that we're purchasing, and that asset costs us $1,000. And we expect that asset to give us $200 a year for each of 3 years. So we're going to say it's $200 at time 1, another $200 at time 2, and another $200 at time 3. And then we expect that we're going to be able to sell the asset for $1,500. And we're going to figure that we sell this asset at time 4. Well, how do we really start to construct this? Well, the cost we'd better think of as being negative values. And I like to use the construction of negative for cost, positive for benefits, because frankly, when money leaves me, that's negative. I don't like that, so I just give it a negative construction. You can do it either direction, but I think it's most commonsensical to think of cost as a negative. And all these other benefits then are positive. So we also have to think about our rate. Let's say that our rate is simple, 5%. So then the net present value of this will be negative 1,000 divided by 1.05. But to what exponent? Well, I typically pay my costs now. If I'm thinking about something where I'm buying an item, I'm buying an asset, it's now. And when is now in terms of a time signature? Now is at time 0. And what we're going to see then is when we have value that's got a signature of time 0, we know that any value to the exponent of 0 is going to equal 1. So a $1,000 cost that happens now is going to be 1,000. But in this case, we're also going to receive $200 at the end of the first, and $200 at the end of the second, and $200 at the end of the third year. And then finally, we're going to receive $1,500 at the end of the 4th year. So let's go ahead and identify the value for each of these terms. Well, we know that negative 1,000 divided by 1.05 to the 0 is the same thing as negative 1,000 divided by 1, or simply negative 1,000. And then we're going to add to that 200 divided by 1.05 to the first, which is 190.48, plus 200 divided by 1.05 squared, which is 181.41, plus 200 divided by 1.05 cubed, which was 172.77, plus 1,500 divided by 1.05 to the 4th, which is going to be 1234.05. Notice here, and we've seen this before, that even though I have a constant cash flow, the present value of that cash flow becomes smaller over time. That's because as we get further out in time, the present value gets smaller and smaller if the cash flow was constant. So this is going to be the same thing as 1,000 plus, and then I'm going to sum the benefits for a moment just for illustration purposes, 1,778.71 or 778.71. What this is telling us, when we have a net present value that's greater than 0, that we received more than our expected rate of return. Where our expected rate of return here was only 5%. And if you look at these cash flows, we see that our annual cash flows are roughly 20% of our original investment, and then we got our original investment back plus half again, so we would expect this to have been much more than a 5% return when we really looked at this. So if our expectation was 5% and we received these rates of return through these cash flows, then we would have gotten much more than a 5% return on this. We would accept this. It would meet our decision rule for acceptance.